Credit card APR. What is it and how does it work? In this video, that's what I'm going to be talking about. Also, if you've heard about APR and APY and you don't know the difference between the two, I'll be explaining that as well. So stick around so you can hear everything. So if you're new here and this is the first time that you're seeing me, my name is Ian, and here on this channel I talk about ways to make money, save money, credit cards, banking apps, investing, and everything that has to do with personal finance. So if these are topics that will interest you, be sure to give this video a thumbs up. I'll really appreciate it. And also consider subscribing to the channel, and when you subscribe, be sure to turn on the notifications, and that way you'll be able to get the updates of when I post new videos here, and I post a new video here on YouTube every single day. So if you want to see more videos like this one every single day, be sure to turn on all notifications for this channel. So APR is actually interest paid to your credit card company. So let's say you have a credit card like the Chase Freedom and the APR is 20% for argument's sake. You use the credit card and you have a balance of $1,000. You'll then be charged around $200 in interest over the course of a year because 20% of $1,000 is $200, and APR actually stands for annual percentage rate. Now, sounds simple enough, right? Well, credit cards actually keep you locked in and paying interest that never seems to be able to stop because they compound your interest payments or your payments. So think about a high yield savings account, for example, or an investment account. If you put $100 in it and you get $1 per month, you get interest based on the total balance in the account. So at the second month, you will get interest not only on $100, but you'd also get interest on the $1 that you got the month before. So you'll get interest on $101 because it's compounded, and you get $1 before in the previous month. Now, credit cards are the same or the same thing, but in the reverse order. So if you have a balance of $1,000 and the APR is 20%, they will also compound the interest, and this interest is calculated and compounded on a daily basis. So each day, the total amount owed gets slightly higher. And so even if you make the minimum payments on your credit card, it will seem as if you're not making any progress, and the balance may even get higher. And that is the reason for it. So APR is often overlooked, and it shouldn't be, because if you keep a balance, the APR determines just how much interest they will charge you on that balance. And you have credit cards that will offer you lower APRs like 16 or 18%. And then you have credit cards that will easily run you 50% APR. So if you owe money or have a balance on one of these high APR credit cards, then paying off this balance is going to be a challenge. So compound interest is now good and bad. When you're saving or investing, compound interest is your friend. But when you have a credit card, compound interest is actually working against you. So if you get a credit card with an offer of 0% APR for 10 or 12 months, it really means that you won't pay any interest on the balance for that term, and you may see these offers regularly. Now, APY, when it comes onto credit cards, is the annual interest including compounding. So APR is just the interest, but it doesn't include the compounding, and APY includes the compounding. And so when you get a credit card, you'll most likely see both rates, APR and APY, and the APY is always a little higher. So that's the reason for those two rates. And if you're going to be keeping a balance on the credit card, then you should pay more attention to the APY instead of the APR, because it will give you a more accurate estimate of how much in interest or the total interest that you may be paying on that card per year when you keep a balance on it. Now, I know you probably get all that and you understand now, and comment down below if you do or if you need me to explain further. But the next part to this is variable APR, and if you have seen this, here's what it means. And guys, if none of this sounds familiar to you, the next time you go to sign up for a credit card or you get an offer in the mail, read through the document and you will see all this info. So there's something called a prime rate. This is 3% or usually 3% above the federal funds rate, which is the interest rate that banks charge each other for overnight loans made to fulfill reserve funding requirements. And this can be for credit cards, car loans, mortgages, and just about any type of loan. So let's say, for example, the prime rate was 3% right now. If you had a credit card with a variable APR and the APR was 15%, and then the prime rate moved to 5% from 3%, then your APR would increase by 2%. So variable APR moves with the prime rate. So this is the prime rate in addition to whatever the credit card company wants to charge you. So if you were ever wondering about that, that's what it is, and that's how it works. Now, you don't have to pay any interest on credit cards. You never do. You always have a choice. Credit cards actually allow you to use them, and not pay any interest as long as you pay the balance in full before the closing date, and this is usually almost 2 months. So if you have a credit card, or I'll use myself as an example now, my Discover card closes on the 15th of each month. So if I use it to make a purchase right now, I won't be getting a bill for that purchase until the 15th of next month. I'm about 25 days away from the 15th of next month. When that bill comes on the 15th of next month, I also have until the 24th of that month to pay that bill in full and get charged no interest. So from right now to the 24th of next month, depending on whenever you're watching this video, but as of right now, that's around 40 days or somewhere thereabout. So I can use my credit card and I have weeks before I have to pay the balance, and I'll still be able to avoid the APR and pay 0 in interest. And if I really wanted as long as possible, I could wait until the day after the statement and then make a purchase or purchases, and then I would have from the 16th of the next month to the 24th of October to be able to pay off that balance without being charged any interest. So this is the way these credit cards or credit card companies operate. Usually you'll get an offer and it will say something like 0% APR for 15 months. And you think, okay, well, this is good. And you get the card and you make all the purchases and you don't have to pay any interest. But if you ever miss the end of that 15 months and you don't pay the entire balance in full, then all the interest and the compounded interest will be then charged, and you may end up having a minimum payment that just barely covers your interest, and then that only keeps you in debt, and that's what the credit card companies really want, because if you're not in debt, then they're not making any money. So I hope this all made sense, and I hope you guys now understand credit card APR, APY, and variable rate APRs. I hope you guys found this video helpful, and if you'd like to see more videos like this one, hit the subscribe button and the notification bell so you can see new videos that I post. And remember guys, I'm posting a video here on this channel every single day now. Now, if you've made it to the end of this video, comment your thoughts down below and any questions you may have, and be sure to also drop a like on this video. It really helps to get this video out to more viewers. I'll really appreciate it. And also guys, giving this video a thumbs up or a like is completely free. And also guys, I'm posting videos here every single day and I'm running out of topics to talk about. So if there are any ideas or anything that you want me to talk about that's personal finance related, be sure to drop it in the comments down below and I'll cover that in an upcoming video. Also guys, I'm leaving a couple links down below to free stuff and free cashback offers, so be sure to check the links down below in the description for all kinds of free stuff. If you're a new viewer or subscriber here on the channel, be sure to check out my other videos on high yield savings accounts, checking accounts, credit cards, investments, and of course, ways to make money. Also guys, I want you to check out WEBULL if you haven't already. WEBULL is a free and easy to use investment platform or app. And when you sign up using the link down below for this month of September, you'll get 3 free stocks. And these 3 free stocks can be anything valued at over $1,000 after you deposit just $100 in your investment account. And you can keep these stocks if you like them. You can sell them and withdraw the cash if you don't, or purchase other stocks. Once again, guys, thank you so much for watching, and I'll see you guys tomorrow.